And general risk off again today, second day in a row. But remember, we're up almost 5% for the month of April. So take a look at the sectors. Tech, mega cap tech is sort of split evenly. They're holding up fine. Banks have been flattish ever since the earnings season started, and that is not unusual at all. That's fairly typical. Energy's flatlined for 2 months now. It's not been going anywhere. Industrials have had a great run up until this week. Consumer staples also have been doing a little bit better up until this week. Two things that matter now. We're in the heart of guidance season. We're interested in costs and we're interested in guidance. Guidance matters because the prices have moved up rather significantly, and we need positive guidance to move the analysts along to keep increasing the earnings estimates. You know how this game is played. So we've had a number of companies raise guidance in the last few days. Dover, big global industrial company, Lockheed Martin, United Healthcare, Philip Morris, and Harley-Davidson all raised guidance here. The important thing is Johnson & Johnson came out this morning. They narrowed their guidance. But business conditions is what we want to hear about. And generally, we are getting the positive commentary we had anticipated. A lot of comments out there. The CEO of Dover cited improving demand conditions. That's the magic word. That's the pixie dust we all want to hear. We need to hear about notably improving conditions in general. I think Scott Kirby at United had the quote of the day, leisure demand at more than 100%. That's a great quote. He was on this morning with us. Lockheed Martin talked about new and better normal out there. The AutoNation CEO had great comments. So generally, we're getting the positive spin, the positive body language that we were anticipating from the CEOs. I have not heard a single CEO come out and said, we're not giving guidance because we don't have any certainty. That's very good news. Nobody wants to hear that. And so far, nobody has been hearing it. The other issue, of course, is the higher costs. If you want to look at, say, Procter Gamble, here's a very good example. These consumer product companies. So they had higher freight costs there in their third quarter, but they've had higher freight costs of $200 million. They've had higher commodity costs of $125 million. And yet, they're maintaining their EPS growth forecast. In some cases, they're hiking prices for baby care and feminine care products. They already did to offset the higher commodity costs. In other cases, maybe they're just eating it. The bottom line is they're able to do it, and it doesn't seem to be affecting their profit situation. This, of course, is the ideal situation and what you want to really see. My thanks to my colleague, Robert Hum, for doing the research there. We've seen this with Coke, too, Kimberly-Clark as well. So far, the good news is higher costs do not seem to be dramatically impacting margins, and that's what we care about. But again, it's very, very early in this earnings season. And of course, Carl will be on top of all of that.
Shepard Smith here. Thanks for watching CNBC on YouTube.